All right, what's up? This week, I wanted to talk a little bit more about financing and funding deals, and I wanted to get into the weeds a little bit on a particular listing I pulled. So I found this listing on Transworld's website. I just jumped straight into the model, so I screenshotted some of the key stuff. It is a boat dealership, so they sell boats and boat engines in Florida. The business did, that's cut off a little bit. It did about 750K of SDE, about $3.6 million of revenue. They're asking 2.6 million, which is about a 3.5 multiple. I modeled up a couple different scenarios because I wanted to show you how to think about funding it three different ways and how different deal terms can impact funding. So I thought this would be a really cool case study. The other thing I liked, and I picked this listing for a reason, to show a business that has a lot of inventory and a lot of FF&E. So the business has a lot of assets. And you can find lots of deals with assets, but the assets in this case may make it easier to fund. And we'll look at a couple funding scenarios that take that into account. So with that, again, $2.6 million purchase price. I think this is actually really fair, reasonable purchase price, assuming all this stuff checks out. 750K of SDE, 3.5 multiple, 25K of deal costs. I kind of threw that in there as a number. Could be a little bit higher, could be a little bit lower, but that's a reasonable placeholder, I think. And so let's look at three different funding scenarios. The first scenario is just a vanilla SBA loan, right? You should be relatively familiar with this. 90% down. I'm going to assume no seller financing, though sometimes SBA can get 5% seller financing, so you only really need 5% equity. But in this scenario, we'll assume 90% SBA loan plus equity, right? So 90% of that is, the math's pretty simple. It's just that times 90% gets us a 2.362 loan balance. And again, this deal size is just taking the asking price plus 25K of working capital. So we can get about a $2.336 million loan. And the business has over $3 million of assets. So that's already, we have a positive asset coverage ratio. So we don't have an airball. We have asset coverage of almost $750,000, which is great. Hopefully, if the loan, if the loan defaulted for some reason, you could sell the boats and still fully pay the loan back, which is great. I love to see that. I modeled a 10-year term for SBA at about 11% interest rate. Those are rough, but not totally off base from where SBA may be today. You're almost always going to see a 10-year amortization. And I think 11% is a reasonable placeholder for where SBA rates are penciling right now. Assumed, again, no seller note, which we'll see in some of the other scenarios. In that case, you need about 260 grand of equity, which is just taking the deal size minus the loan balance and the seller note and any equity roll or earnout, which we don't have in this scenario. So you need about 260 grand of equity, and the deal would cash flow about 360K a year, right? So in this scenario, if you have 260K or you go raise it from friends and family, if you know a few folks who are even moderately wealthy, it's not difficult to get a couple folks, 3 or 4 people to put in 50K each. Suddenly you're there. One person stroking a 250K check is not uncommon at all. 3 people putting in a 100K check, maybe overcapitalize the deal a little bit, put some extra working capital in there. All of those would be ways you could raise equity to get the deal done with traditional SBA financing. So let's look at a scenario. What if we could only raise like 100 or 150 grand? How about a scenario where we get a 65% loan from a bank, potentially an asset-based lender, and then we get the seller to carry a piece of it. So in this case, I said we have a 65% loan, right, which is about $1.7 million, even better asset coverage with our lender, and that should get a lender pretty comfortable. In this case, a $1.7 million loan is, barely over 2 times SDE, and it's almost double asset coverage. So this is very conservative. Most lenders shouldn't have any issue with a loan like this, given this collateral base and this earnings stream. Most lenders will have, in this case, a shorter term. I took a 7-year term here. If you can negotiate a 10-year term, great. But a 7-year term that is going to make the payments a little bit higher or closer to the SBA payment, even though the loan balance is much smaller. But the pro is that you're going to be paying that loan off at a faster clip as well. And then the rate may be a little bit less, may be similar. I just modeled it here at 10%. Actually, I'm going to go and adjust it in the next one too. You can even get with some lenders, if you're fixing your term, you can get better pricing than this even in today's market. You might even be able to get something kind of 8 to 9% range, but 10% is pretty conservative. Then here, I came and said, hey, what if we negotiated a 30% seller note with the seller? right? Which is, if you look at, it's just about 1 times SDE, which I don't think is uncommon. I think this is on the higher side of what I think a seller would agree to or what I think is market, but I regularly will put in term sheets or LOIs that have the seller carrying somewhere between 20 and 30% or somewhere around 1 times the earnings of the business as a seller note. So I don't think it's uncommon. I don't think it's unreasonable at all to have that. And in that scenario, I assumed an 8% rate. That's where I'm roughly seeing seller financing price today. You might see some sellers who push back and want higher, but I don't think that's unreasonable. At an 8% rate, interest only, that is about $63K a year in seller payments. In this scenario, you would only need $131K of equity, and you would have just a little bit less free cash flow. But I think a big difference here is you not only need less equity, but you also have, if there is any sort of personal guarantee associated with this loan balance, the risk is much reduced, right? So you have a lower payment, you have a better asset coverage ratio, and you have just an overall lower loan balance, right? And you need less equity. So if you can only raise 100 or 150K, this might get you even closer. And magically, if you push that up a little bit, if you push that seller financing to 35%, or you maybe push that loan balance to 70%, which I think is still very much within the tolerance of what a traditional bank or maybe an asset-based lender would give you with this asset base. Some of it would depend a little bit on the quality of the collateral and how they felt about it. You could easily end up in a deal where you don't actually need to put any equity in. Right now, that may shrink the cash flows down a little bit. But I wanted to show you a couple scenarios. Lastly, and this is where we can get really creative with things like earnouts as another means of pushing the deal over the finish line, right? So in this scenario, I assume the same financing, 65% loan to value, either bank loan or asset-based loan, $1.7 million loan balance, right? So that's just, again, that $2.6 million times 65%. Had to fix a slight error in the spreadsheet. The loan payment should be the same because the loan balance is the same, the rate and the terms are the same. Seller note is unchanged, but here, if we couldn't raise the equity, this is where looking at something like an earnout could be a really powerful way of getting the deal over the finish line. And if you notice, if you get a $150,000 earnout, which on a business that they're asking $2.6 million and it makes $750K a year, that earnout is not a huge number at all, right? It's pretty small. As a percentage of the deal, it's it's less than 10%, right? It's probably like 6 or 7% of the purchase price or something. So small earnout, but it pushes that equity need to where the deal's actually cash flow positive because you're overfunding it a little bit with the loan, right? So you actually net just under 20K of additional cash when you close the deal, and the cash flows are still the same. You may have to reserve some cash for the earnout, which we'll talk about in a second, but I think it's really cool to show how an earnout can be another vehicle to reduce or eliminate the need for equity and push a deal over the finish line from a funding standpoint. Here's 3 different scenarios of how you could structure the earnout to be totally cash flow positive, right? So the first is just really simple. $50K a year for 3 years, that equals $150K, right? If the business, it maintains at or above $750K of SDE, which is about where it is now, right? So in that scenario, you would have to pay $50K for the first 3 years. So your cash flow would only be about $300K versus $350 here. But just something to think about. We could also extend that out over time, right? So you could say, I'll pay you $30K a year for 5 years, still equals 150K if it maintains that same profitability level, right? So this is basically saying, hey, if the business is steady state, I'll pay you a little bit extra, assuming there's no big issues with the performance of the operations. And that makes it a little less burdensome, right? You'll still have about 320K a year free cash flow. And then lastly, we could make it contingent entirely on the business growing, right? So we could say, I'll pay you $50K a year for the first 3 years if it does $800K a year or more in EBITDA. And this is called a self-financing earnout, because in this scenario, the business is doing $750 now. We're saying if it does 800 or more, I'll pay you $50K a year, right? So basically that first $50K in SDE growth just goes into a bucket and then gets paid out of the earnout. And you're only paying the earnout if the business grows or performs better. I thought this was just a cool way to show you a couple different takes on how to structure an earnout and how an earnout can push a deal over the finish line. So hopefully this gives you a sense of a couple different ways you could think about funding deals. And one of the biggest takeaways here, there's really 2 things that make this deal make a lot of sense and make the funding really compelling. The first thing is that the price is right. The multiple is strong. 3.5 is a great multiple for a business like this. And the second thing is that the asset base is really strong, right? So you have $3 million of assets. When you have a great multiple and you have good asset coverage, the financing is a lot easier. And so sometimes if you're looking for deals that are little to no equity or equity light, finding deals that have those characteristics can be a great starting place. Hopefully this helps you think a little bit about funding. Let me know what you think. Hit reply. I'd love your take on this deal.